Dollar cost averaging is the process of investing fixed dollar amounts at regular intervals, scheduled intervals. Let's say once per week, once per month, or once per quarter. For example, let's say I want to invest $100 every month in the shares of a particular company. So I make a plan or a commitment that every month, let's say the first day of every month, I'm going to take out $100 to buy shares in this company. Once I've made this plan, once I've made this commitment, I have to stick to it, regardless of how the share price changes. So let's say in the first month, the shares are worth $10 per share. And with $100, I can buy 10 shares in the first month. In the second month, let's say the share price has fallen to $9 per share. Now I've made a commitment to invest $100. So I will still take $100 to buy shares in the company, and at $9 per share, this time I can buy 11 shares. In the third month, the share price has gone up to $13, but I've made this commitment, I'm still going to take $100 to buy shares in the company. So at $13 per share, what I buy is 7 shares. What we can see here is that regardless of how the share price moves, whether it goes up or down, I am investing a fixed dollar amount of $100 every single month. And what this means is that as the share price falls, I'm able to buy more shares, and as the share price increases, I will be buying less shares. Now this could sound quite tedious. Why should I bother doing this? Well, firstly and most importantly, dollar cost averaging helps us to build and develop discipline. And discipline is a very essential ingredient. It's a very important factor to becoming successful at investing in the long term. By creating and sticking to a dollar cost averaging plan, what we've done is actually we have developed a systematic approach whereby we're making investments of fixed amounts at regular intervals. And it doesn't even have to be a big amount. It doesn't even have to be a sizable investment. What we're doing here is establishing and cultivating a habit, which is a very big step towards building discipline in long-term investing. The second important benefit to dollar cost averaging is that it helps us to manage, to deal with the emotions that often come with investing. Now, let's say you want to buy the shares of a stock. You open up the chart and you see this particular pattern. And you might think, oh, it looks kind of overextended right now. I'm going to wait for the price to drop. Because, we're told that, the market always will pull back. So, all right, let's wait. But what if it doesn't pull back? What if the share price continues to go higher and higher and higher and higher? And then we might be thinking to ourselves, regret. Why did we not go in when we thought about going in and we had the chance to go in at a much lower price? Why didn't we do it? Or perhaps in another example, we want to buy and we have seen a price pullback, a price correction that looks something like this. Oh, it's really come down by about 30%. It's sitting on a major support level. It's sitting on some Fibonacci confluence level. All the stars are aligned. It's a perfect time, and then okay, we're going to go all in, put all our money on this particular stock right now. And then what happens? Bam! It continues to fall even lower. Maybe even drops another 30%. What? How? Everything was perfect. How could this happen? And then we start to feel feelings once again of regret and remorse. Why did I put all my money into this? Why did I go in at this point in time? And some people even capitulate. They end up taking a loss and selling the shares, even though they have done all their research and this potentially could be a really good company, a really good investment. So we can see there are a lot of emotions that come with investing, especially when things don't go the way we think they might. And we forget that, nobody can predict what the market is going to do. So dollar cost averaging can help us to manage such emotions because we're buying fixed dollar amounts at regular intervals. That means we're not going all in on our investment at one particular point in time. If the share price continues to fall, we are still buying. But because it's cheaper now, we can actually buy more shares. And if the share price increases, we're still buying, but we're just going to be buying less shares. But over time, we are still going to be invested in this stock. We've built this systematic pattern, we've built this habit for how we are going to be invested. And the impact that price changes can have on our emotions is going to be a lot less when we have a systematic routine, a habit that's put in place. However, dollar cost averaging does not guarantee that our investment is going to have returns, is going to make money in the long term. All right, we still have to do our research and be reasonably convinced that this is a good business, that is going to grow and be profitable in the long term, and that gives us a higher chance that our investment is going to be worth more and make money in the long term. Please don't use dollar cost averaging as an excuse to buy more shares of, some crappy stock that you bought on a whim that, is losing money right now. If you have no fundamental basis for the success of this particular stock, then you're basically just gambling. It could work. I mean, I'm not saying that, it's not going to work, but it might work. But it's really more like you're leaving things up to chance without a fundamental basis that, this stock could potentially recover. At the end of the day, dollar cost averaging is just a method, it's just a tool that you can use, first of all, to help you to build discipline, to build a systematic routine for your investment. And it can also help us to manage our emotions that, we experience when the price moves either in or not in our favor. Alright, so that's it for today's video. So like, comment, subscribe if you found it to be helpful. I'll see you in the next one.